Hello, everyone. At this point, you have read through PowerPoint, watched my uh, podcasts explaining the general principles of accounting and the terminology and definitions. And so, what we want to do now for a little bit is see how they might apply. And so, to do that, we're going to have an example here. We're going to look at the annual report for American Eagle Outfitters. uh, Looking at the financial section, it starts, and then again, this is typically in a report. This starts on page 38, so we're ways down. There's a lot of explanation material early on in the report, but this is the where the actual financial statements start. This is the report of the auditors. We're not going to look at that uh, per se, and you'll see that next is the balance sheet, then the statement of operations or the income statement, uh, statement of comprehensive income, statement of stockholders' equity or changes in stockholders' equity, and finally the statement of cash flows uh, that you should all be familiar with. Then what we run into is what's referred to as the notes to the financial statements. And this is where explanations are for the various elements that you see. And you'll see a lot of kind of explanation about how they've applied these general um, principles of accounting. So, for instance, as you look at business operations, we talked a little bit about when it was founded and how long it's been in business. Okay, what the business looks like. So you get a sense of the business entity. Um, all right, that you are dealing with. So you're starting to talk about what things might be useful for making decisions so that you may understand the material that's being presented. So if you kind of refer back to this conceptual framework, you'll see some of these things applied. All right, so we're going to go back to that report. You'll see the merchandise mix, and then either the first or second is usually a summary of significant accounting policies. And this is where we'll probably spend most of our time here. Uh, Principles of consolidation. What is included in the company? What is the entity that we're dealing with? And then here's fiscal year. Why do we care what year we're using or what time period? Well, that's an important concept because it tells us how timely the information is. And remember, that's one of the enhancing qualitative. We need for it to give us predictive value and feedback value. It needs to be timely. It needs to be relevant to what we're doing. And so this is telling us that we have, in this scenario, this fiscal year and what it time frame when it starts and stops, and that there's 2 years compared. Uh, so we're emphasizing the fact that it is comparable, that there are 2 years side by side we can compare based on this information. So already in this, we've found a couple of applications of those principles that we learned earlier. Next one tells us that there's estimates. That under GAAP, we make a lot of estimates. There's not exact numbers for some of the things, and there's several items on here that have been estimated. And we feel like that's relevant and that is useful for making decisions rather than waiting for the exact amount or being able to determine that. We sometimes need to estimate the future. For instance, we may estimate how long an asset's going to last so that we can calculate depreciation. So this is to remind us that some of those things are happening, and that is to help us get information to make decisions now that it would not be timely if we waited too long. Okay. Then there's usually some explanation of how they've applied new changes, okay, to accounting. And one of the things that we want them to be is complete, and meaning we've looked at and we can rely on these because they have applied all the rules, okay, in an understandable way. There's It also affects our ability to be comparable, because if we change rules midstream, then some things will not match up. And so we need to make sure that everybody understands how that might work, so that they can actually make comparisons between companies uh, and that sort of thing, and years for that matter. Uh, so, foreign currency translation, this is telling us how we handle measurement. So, one of the things we talked about is how we measure the amount of an asset or liability. Well, one of the things that goes into that is what foreign currency do we use, or what currency do we use, and how do we translate those parts of the business that are in a foreign currency. So, and for American Eagle, where the company is located in the United States, any operations outside the United States would be done in that local currency and have to be translated into, and that affects our income, as it says here, refer to note 11. Okay, so that's an important piece of our measurement. Uh, so, cash and cash tends to go through the balance sheet and describe some of the things that apply to various things, various elements of that balance sheet. Um, so the definition here, the recognition, if you will, what does it mean to have cash? What are we describing here? And what is it measured at? Okay, and you'll see that there's more under note 3 that will tell us how we measure that cash equivalent. Inventory is the next one, and you see that it is valued at lower of cost or market. That is a form of measurement. So we recognize inventory, that's the stuff we're going to sell, and the value or the measurement of it is average cost using the retail method. And fortunately for you, we're going to learn all about that a little later. Okay, they use an average, not a FIFO, not a LIFO, but average. And this kind of tells you how they deal with an inventory reserve or markdowns, when they have to put things on sale in order to get rid of that. That's that lower of cost or market, and that's what we refer to as subsequent measurement, and so forth on down here. Measurement, there's the original measurement when we bought it and how we put it down on the balance sheet, but then we have subsequent to that, any change in the value or amount, and then of course how that would be presented on the financial statements needs to be reviewed. So continuing on, we see that there's some property and equipment. You see how they depreciate it, what the useful life is, weighted average of those, some of the rules that apply to that, and how they deal with things like impairments and carrying amounts. Again, measurement ideas and a concept of how we apply value to those, and the amounts that you would just needed to be described, that sort of thing. What goodwill is, other intangible assets, why that's would be relevant to business decisions, especially the idea of possible impairment to a goodwill, which indicates we may be having trouble with our businesses, and whether they're doing well or not, and how we determine that will be more described in note 8. So you see that there's several places here where those are referred to other places. Some unusual kinds of items might be described here. Self-insurance liability means instead of buying insurance, American Eagle just sets aside a certain amount of money that if there's claims that they can pay. And so obviously that's a big estimate as to how much those claims are going to be. I deal with credit card, anything that might indicate something unusual. Rewards program, how they deal with that liability and how that would be recognized. Why is that relevant to decision makers? Okay, all right. So they're giving you an idea of how that, and they even use the term revenue recognition. Obviously, if there is later things that they still need to be done, that the revenues fully hasn't been earned fully, and we'll look at examples of that in a little more detail later. But this gives you an idea of how that revenue recognition or other principles are applied, income taxes, and then as you can see, this just keeps getting more and more detailed in terms of that, and it actually will deal with several of these things. What constitutes what they mean by various expenses, how they're measured, how they're reported and shown on the financial statements, why they are relevant, how much they are, that sort of thing. Legal proceedings. Notice that down here um, that outcomes of the matter pending against company not material. That means that they have determined that this um, cost benefit analysis and materiality, when they applied that, it wasn't going to be a big enough a number to make a difference. That's what materiality means. And so they have essentially applied that to their idea of legal proceedings. They've been sued, yes, or we may even lose some of the time, but we have insurance and we have other things that we're going to make that loss small enough that it's not going to matter, and so forth. Okay, so and you'll get the feel for this. Again, the idea is to be able to refer back to our general principles as you look at financial statements, as you look at footnotes going forward, so you understand how these all relate together. So that is our first idea of practicing application of these general principles.